A question that stock investors are eventually faced with is whether they want to load up their portfolios with value stocks or dividend-paying ones. The choice ultimately boils down to the psychology and investment philosophy being adhered to. The condition of the economy and demographic factors such as age also play into this decision. Those that prefer dividend stocks look to avoid price volatilities in the short term. However, even those chasing growth have been increasingly turning towards dividend stocks, given the wider uncertainties plaguing the markets. With inflation hikes and a looming recession, buying moneymaker stocks could smoothen out the circumstances for many investors. Moreover, those that pick undervalued dividend kings could benefit from value growth, in addition to high dividend yields, resulting in a win-win opportunity. In light of this, we present some of the best dividend stocks that are a must-buy in 2022. We start off our list with the utilities giant, Duke Energy Corporation, which trades under the ticker DUK. With a market capitalization of $84 billion, Duke Energy stands as one of America's largest electric utility companies. There is little about DUK, which makes it exciting with innovative breakthroughs or revolutionary tech advancements. For those seeking dividend kings, however, this aspect makes the stock an ideal moneymaker, and not one prone to price swings. Demand for electric utility remains largely stable, even in the face of the most tumultuous macroeconomic headwinds and during recessions. The stock, therefore, is ideal for holding during times of crisis, and capturing value in the form of dividend payments. Duke Energy presently offers a dividend yield of 3.8%, which annually amounts to over $4 per share. What is impressive about this is that the management has been consistently pushing dividend hikes each year, which is mostly above the 2% mark, which happens to be the US Fed's target for inflation. As a result, DUK is great at preserving one's purchasing power amid broader circumstances. Moreover, its exposure to nuclear energy offers a growth potential, in a context where governments are actively pushing for an end to oil reliance. In light of all these factors, Duke Energy is perhaps one of the best defensive dividend stocks one could consider investing in. The second stock on our list is that of the IT specialized REIT, Crown Castle Incorporated, which trades under the ticker CCI. Crown Castle is one of the leading names in the wireless infrastructure realm, which boasts strong and diversified income. Just as the case with electric utilities, the communication industry offers a powerful moat against economic uncertainty. The primary earning for Crown Castle comes through the leasing of its cell towers. Revenue originating from this source amounts to almost 2/3 of total sales, and holds a gross margin of an incredible 70%. This indicates CCI as being a true value creator for its shareholders, whilst capitalizing upon incredible demand for communication and internet. Similarly, over 30% of its revenue is attributed to the dynamically growing fiber domain. This allows the company to profit significantly in the most densely populated zones within its target market. Additionally, its fiber infrastructure segment adds significant upside potential to its robust, money-making business model. In terms of dividend, CCI is an extremely compelling pick. Although its dividend yield stands at 3.3%, this has a growth rate which is calculated as being an impressive 10.6%. This is far above inflationary standards. In comparison, the average dividend growth rate on REITs is a mere 5.2%. Such incredible growth is possible through the dynamic management of Crown Castle, which is constantly innovating and keeping track with new technologies in the ICT space. Before we proceed to the next stock on our list, we hope the options presented in this video so far have been insightful. If the list has proven beneficial to you so far, do subscribe to our YouTube channel and turn on the bell notification. Furthermore, we also offer a morning newsletter to our email subscribers. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If the list has proven beneficial to you so far, we would appreciate you clicking on the like button to show your support. Number 3 on our list is America's largest bank, and a renowned name in the global financial systems, JPMorgan Chase Co. The company, which holds the ticker JPM, has a balance sheet that reports a financial position of a staggering $2.87 trillion. A figure of this magnitude indicates its ability to pay its shareholders an annually increasing dividend with relative ease. It is impossible to understate the position JP Morgan occupies with respect to the global financial network. It is amongst the leading names in both investment and retail banking, as well as wealth and asset management, and global markets. For its 2021 final year results, JPM reported earnings per share of $15.40, compared to the previous year's $8.89. A jump of such an immense proportion indicates booming business opportunities being capitalized upon. Despite such tremendous fundamentals, the stock is down by almost 30% since the start of the year. This presents a great buying opportunity for those that find JPM attractive. In terms of dividends, JPM presently yields at 3.46% and has been consecutively upping these payments since 2015. Buying the stock now, while it is still at a significant discount, would be a tremendous bargain for dividend chasers. As its share prices match up to its robust fundamentals, this dividend yield would come back closer to the industrial average. Next up we present the giant investment manager, BlackRock Inc., which is also known as BLK. BlackRock holds an extremely resilient business model, through which it serves institutional, intermediary and individual investors. Over the years, the company has enjoyed tremendous performance, and has established itself as one of the big-name players in financial services. In the last 10 years, the company has more than doubled its revenue, with its total assets under management exceeding the $10 trillion figure. Earnings per share has grown even faster than revenue, owing to share buyback programs and structural optimization by management to boost profitability. BlackRock has been paying out growing dividends for the last 20 years. The only time this was stopped was in 2009, during the financial crisis, after which it maintained its steady trajectory. Furthermore, its yield stands at almost 2.8%. This is not the highest yield among some of the names we have presented on this list, but its robust fundamentals make it a highly safe stock to include within any investor's dividend stock portfolio. Moreover, the company pays out a mere 45% of its earnings as dividends, and retains 55% for growth and reinvestment. This is great for those who also hold concern about the long-term money-making potential of the stock. The final stock on our list, but far from being the least, is one of the leading names in the global information storage industry, Iron Mountain Incorporated. Iron Mountain, which trades under the ticker IRM, is essentially a specialized REIT, and supports over 225,000 clients across the world. Given the nature of the industry that IRM caters to, it is supported by strong tailwinds that are seeing global industries speed up their push towards digitization. This momentum dramatically picked up pace since the COVID-19 outbreak. Its positioning as a leader in this market has helped it capitalize on these opportunities and enjoy stellar growth. In the last 12 months, Iron Mountain grew by 20%, in a period where the S&P 500 fell by almost 7%. Its revenue climbed by an impressive 15% in the first quarter of 2022, on a year-on-year basis. The management is confident that it will maintain this double-digit growth trend throughout 2022. Looking at the stock from a dividend standpoint only enhances its overall attractiveness. The stock's dividend yield is almost 5%, whereas its 4-year average yield is calculated as being above 7%. Its trailing payout ratio stands at almost 70%, which means most of the profit this star player earns is going out as dividends. The stock has all the markings of a dividend king that one cannot ignore for their portfolio. That's all from us in this video. We hope the insight we aim to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for maximum and sustainable dividends. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstellograph.com.